Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, and the talk point today are the views of Manish Gunwani. He needs no introduction, and at a time like this, it's opportune to have him. Manish, great having you. Hope all is safe.
Thanks for having me.
The pleasure is ours, Manish. So, Manish, I mean, never mind the bit of a corrective move that we've had in the last 30, 45 odd days. It's not been a bad year. What's the case for money making in 2002 now that it seems that the central banking put is no longer a given, and the fact that equities are now no longer the only game in town? I just read an article today that crypto attracted the most money in 2021.
Yeah, I mean, on days like this, it's I guess difficult to be optimistic. But yeah, I think let's not forget two or three good things going into 2022. One is when you say the central bank put, let's remember that US bond yields are back to below 1.4. Um, and while liquidity provided by the Fed is one thing, ultimately from a more fundamental basis, it is the cost of equity which determines the cost of capital, which determines stock market level. The cost of equity is more linked to the US 10-year yield, and clearly at 1.3, 1.4, it doesn't look likely that cost of equity is going to go up a lot. So related to that is the point that real rates, if you see globally, not only Fed, but even from a domestic perspective, we all know that the bank FD post-tax today is yielding fairly trivial returns. And if the US interest rates are likely to remain low, that's unlikely to change. So this whole tailwind for equities, which has come from cost of equity being low, especially in real terms, I think that is unlikely to change. The second point is, especially from an Indian perspective, a lot of the earnings growth over the next 2-3 years are coming from things like commodities normalizing, credit cost normalizing, telecom normalizing. And there is very little reason to believe that even if global growth goes up 0.5% here or there, these normalization trends are unlikely to change because all these industries were subnormal ROE for long period of time. So that high teens, low 20s growth over FY 21 to 24, that 3-year cycle, that is unlikely to be affected whether Fed withdraws liquidity, commodities go up or down a bit, global growth goes up or down a bit. Not really going to change this because led by, as I said, more of normalization of low ROE returning back to normal ROEs. That's the second point. Third point, remember that 3 months back or even maybe 2 months back, the biggest worry was margins and inflation and commodity prices. So whatever's happening post that, obviously, I think the outlook on margins or commodity prices is good for corporate India today. So anyone in domestic consumption using plastic or steel, I'm sure the price pressure has flattened out. So looking forward, you can both see commodity pressure easing off and supply chain pressure like auto got hit by chips. I'm sure with global growth becoming a bit more softer, all those supply chain pressures will ease out. So, so I think these are fairly big positives. We've always been saying at this valuation, we shouldn't expect multi-bagger kind of returns. I think for a steady, return with some P coming off from a strong earning growth, that kind of paradigm, I don't think anything really changes. You're correct that we've seen the mid cap index up 40% this calendar year. So 4-5% correction should not really matter too much in the long run.
But you reckon that there could be a case for India being an outlier in growth, even and and that attracting money, even if the rest of the world is going through a challenging time, both on growth as well as maybe valuation corrections happening. Can India still be an outlier in the eyes of investors? I mean, you guys
So,
are doing very well on the domestic side, but globally, money isn't coming in this year.
yeah. So I think lot depends whether it's a global slowdown or global recession. Obviously, the global recession. See, Indian cycle is also linked to global cycle. We have all seen 2003 to 8 or whatever 2 year cycles we've seen over the last 10 years are broadly in sync with the global cycle. So we shouldn't fool ourselves and say global cycle slows down, we will always be rocking. The question is globally, is this a mid cycle or is it end cycle? I mean, it's a trillion dollar question, obviously. As of now, the general expectation is it's mid cycle because a lot of regions have still not fully recovered from virus. There is a lot of, I mean, global GDP has gone back to pre-COVID GDP broadly, but it's not obviously still below trend, right? A lot of regions, especially emerging markets, have not really performed to their economic potential last 6 7 years due to various reasons, whether it's trade war or corona or whatever. So there is the general expectation is we're still in a mid-cycle pause because of virus resurgence, because of China taking some policy steps to cool down their economy, and I think 2022 can see China coming back a bit because the policymakers already changing direction. So yeah, so there are a lot of moving parts, but I don't think these are conditions like 2007 where you can say that global GDP has run up so strongly that you're expecting a big crash. Now, obviously, if this Omicron turns out to be a three sigma event, nothing can be ruled out in that sense. But yeah, I think this looks theoretically more like the 2006 May correction, where there was fear of Fed tightening. The global economy was doing well, and we had a very sharp correction based on liquidity fears. But if on the other side we come out with reasonable economic data, I think we should be able to absorb this.
Hmm. So, in that light, Manish, are you okay? If you get large dollops of money, let's say the Indian investor suddenly decides that in Jan, Feb 2021, I want to increase my allocations, while you may be have the mandate to be fully invested, if you had that option, would you sit a little bit? Would you keep a little bit of gunpowder dry for the possibility of the unknown, and there are a few around there, or
Yeah.
would you be comfortable deploying
So
everything?
I would keep some gunpowder because on the domestic side, I see two concerns which I think need to be resolved before you go in fully. So it's not about valuations to my mind because valuations adjusted for global cost of equity. You can argue, but I don't think it's a very clear bet. The two concerns I have at this point are one is the trade deficit. Now, we all know that as a business cycle picks up, generally what tends to happen with Indian economy is at the bottom, which we've seen in 2002 or 2020, at the bottom when things are very slow, our current account deficit broadly zero or marginally surplus. And as things start picking up, our current account deficit goes up. But what I think at the margin has been a concern that even early in the cycle, we've hit a trade deficit of $20 billion plus, which roughly amounts to 2.5% of current account deficit. Now, that is not something which is very healthy to my mind. And now, there could be some lumpiness of gold consumption during festive season, but still adjusted for everything. I think that is what something gives me a bit of nervousness about Indian currency, for example, which is why maybe until it absorbs that bad news, we may not see foreign inflows. The second thing, which is again very difficult to pinpoint exactly, there is obviously a host of reasons, is that somehow the rural side has been very slow. So whether it's two-wheelers, FMCG, microfinance, we've all seen that the growth has not been quite strong, and it was kind of expected that rural will lag urban because urban balance sheets, especially of the top 10-20%, tend to be stronger. So a 15-month crisis or a slowdown like what the virus caused, you would expect that urban would recover strongly versus rural. But even then, whether it is because of fertilizer shortages or a lag in government spending or the fact that their balance sheets took bigger hits in the last 15 to 18 months, whatever be the reason, versus expectation, I think the rural side has not really fired at all. Um, and since there are multiple reasons, you don't know how long this will go on. And I don't think it's healthy again for this economy because rural is important both from an economic and political standpoint. So it's necessary for rural to fire. So these two would make me kind of pause at the margin.
All right. Manish, just one quick follow-up macro before I dwell on some things that you think otherwise. But is there a positive spin to this in that we're already seeing absence of wage growth, presumably due to the points that you're mentioning. In the absence of wage growth and with a belief that at some point of time, supply side will resolve itself to an extent, the much dreaded fear of inflationary pressures
Yeah.
might be a bit mitigated.
Yeah, I think if I go by what's happening globally, in the sense that you're seeing that bond yields are refusing to go up in spite of Fed talking hawkish. And even in India, what you mentioned, that if you see, so the drivers of inflation are very different in US versus India. US is very wage inflation, very white collar kind of inflation led. India is a lot about commodities, right? Because food and energy are a big part. But both sides, maybe more on the Indian side, there is reason to be optimistic because most of commodities, whether it's iron ore, aluminium, crude, are anywhere between 10 to 30% down from the peak, if not more. So yeah, I think the challenge will be growth rather than inflation, which is why I'm saying that the chances of a big crash may be mitigated by the fact that if inflation doesn't go up and cost of equity remains on, then the sectors which work will change. Defensive sectors may still give you some return and they may outperform if there is a big slowdown in terms of growth. But I doubt that the market level itself will correct too much.
Manish, okay, so in which case, and thanks for correcting me out there. I mean, I kind of clubbed both the global local thing into one, but yeah, the nuance is there in your answer. So thanks for that. Now, you mentioned this critical point about how the themes may change, not necessarily purely out of rotation, but maybe because purely fundamental reasons as well. May I start off by asking you, how convinced, not convinced are you about industrial stroke capex related themes making a comeback? We're seeing bits and pieces, private capex starting in, but in very selected sectors. Government capex, at least state government capex at the margin, seems to be ebbing. Are you convinced that at some point of time we'll see sure shot evidence of some of these coming back, or are you not quite convinced there?
So I am fairly convinced of a Capex cycle. Unfortunately, I think the nature is such that whether we can access it fully through the stock market remains a question. In the sense that, see, a lot of our industrial plays derive a lot in terms of segmental push from thermal power, roads, let's say, real estate. But the real action this cycle could be renewables, data center, telecom equipment. There are not too many large cap plays. Also, it's more technology intensive stuff like robotics, process control, where obviously players are there, but mostly MNCs where valuations are stiff. So the nature of capex, that is one part of the challenge. Um, the other interesting angle to this is when we look at capital good stocks. Traditionally, the domestic cycle had a lot of bearing, and it still does. Obviously, that's the major driver. But also, there could be selectively this China plus one angle where a lot of these capital good companies may become exporters of stuff, which is already there. I mean, if you see most of the MNC majors, anywhere between, let's say, 15 to 40% of output actually exports. So there is some positiveness or optionality, let's say not positiveness, maybe optionality at this point of time, that more and more sourcing from the global parents may happen given what is happening in China, etc. So yeah, I wouldn't say that I'm heavily bullish on the entire sector because of technology issues, because of the segments like solar and data center are not there in the listed companies. And this China plus one is still very nascent. But yeah, I mean, it's one of the sectors which you can't brush off, but yeah, it's very selective where you want to be.
Okay, so maybe I should have started off this way. Where is it that you believe the rotation will see favorable output? Where do you see the rotation will see, or do you think that will actually not benefit in 2022?
Yeah, frankly, it's one of those times where it's very difficult to take a sectoral bet because I'll tell you why. The reason it's very difficult to forecast currency at this point of time. You clearly are seeing dollar remain reasonably strong. You have the nascent worries of India's CAD, which these should be negative for the rupee. But India has obviously been one of the best EMs in terms of overall outlook versus Brazil, China, South Africa, especially when commodities are correcting. EM flows relatively should come more to India. That looks logical. And dollars already appreciated quite a bit, so we don't know at the top of the dollar cycle. Uh, so why I'm giving you all this yarn is basically
No,
on
it's very
things like
helpful, please.
on things like IT. It's easy to be negative from a contrarian / value perspective, saying multiples are expanded, but I would still remain equal weight or even marginally overweight. Just to protect myself against steep fall in currency. Ideally, if you see trade deficit come down, then you can be underweight IT. But yeah, at this point, you need a bit of currency protection. Um, so where I think maybe a good risk reward is basically domestic consumption plays, which have suffered a lot from inflationary / commodity escalation, and where you feel there is a good fight in your story. Um, then that could be selective spots where could be partially auto, partially non-auto as well. But yeah, some of these have obviously suffered from margin pressure, and then from a it may not give you immediate return because obviously at this point the pure defensive sector like IT, healthcare, maybe FMCG may work better. But I think the more discretionary elements where there has been a lot of margin pressure, both even on capital goods side. Those could be interesting.
Just a quick follow-up. Urban auto necessarily, because rural, as you said, seems to be a bit of a limbo right now.
No, but if you see right across two-wheelers, four-wheelers, and CVs, I think there is good value emerging in the sense that so there are multiple themes there. Some of these OEMs are trying to create value in the EV space, right? The two-wheelers on free cash flow yields are maybe above 5-7% in some cases. So there's, I don't think you can lose much, but you also need a growth trigger. But so it could be either EVs or something else, or exports, for example. But yeah, I think there is, as a value investor, that's the only space I think there is good risk reward to my mind. I mean, there is commodities, but as I said, if you think, we all know that irrespective of valuations, commodities, stocks typically don't work when commodities correct. So not that excited.
Yeah, no, makes sense. Manish, one final question. You referred to China plus one twice in our conversation. Where have you seen telltale evidence? I believe most of those pockets are known, but let me ask you, let me rephrase this in your conversations with managements as well. Where do you see signs of this continuing / accelerating, and therefore the benefits spread out over a period of 3, 4, 5 years, maybe, as opposed to bunched up um, in a short time?
So we've seen the narrative gather momentum sequentially. So one is chemicals, where it's very well established, stocks have done well. Then electronic manufacturing, again fairly well known. I think textiles is where it can come in. Industrial goods, what I was talking about, capital good, a lot of these MNCs, there you're beginning to hear of factories being planned for that. I think auto and others, I think we haven't seen too much momentum on the ground yet. Obviously, the schemes are there, but yeah, I think logically it should come in broadly every manufacturing segment, I guess.
Okay. Well, let's hope that the tide is looking slightly better when we speak next, whenever we do. But Manish, thanks for your time. And to you and team and family, have a great 2022.
Thanks for having me.
The pleasure is ours. Viewers, thanks for tuning in.